Hey, good morning, Ron. Good morning, everyone.
Morning, Kath.
Boy, we got a great show today. I think, Ron, you thought that this might be one of the best shows we're going to have about the big disconnect.
I think it can be. Let's see how it goes. But
Okay.
it's on everybody's mind, and this is actually. If you want to show the first slide, Kath, I just want to get right into
Okay.
just. We got a lot to say today. Just want to jump in. So this is the last episode of our first season, and we have 15 episodes now for you to watch. And just want to encourage you to come to our library, and we've done. Most of the shows are investing, but we've covered other topics as well, like Social Security, Medicare. We even had one episode on the future of mankind, which was really a fun episode.
Yeah, that was very interesting.
Yeah, it was. It was a lot of fun with a really smart guy. So just so you know, we're not just about do-it-yourself investors, although many of you are. We also work with you about how to work with your consultant. And our major emphasis has been on our view that baby boomers, most are getting, they're taking too much risk and they're taking bad advice in a nutshell. And we're going to show you today how that fits into the current disconnect between the market and the economy. So next slide, Kath.
Okay.
So I don't think anyone on this call would disagree with the fact that the economy is tanking, but the stock market keeps on going up.
And nobody knows why.
I'm reading everything I can, and I'm going to share with you the explanations I've heard, but they're really not very satisfying. So in fact, I'll do that in the next slide. Let me tell you the things that I've heard.
Okay.
And see if you agree. So the things I'm hearing, and there's two things. One is basically wishful thinking. And I've seen a word that I really like. It's called opium.
I like it.
Yes, it's pretty cool.
Yeah, I like that.
Yeah, so it's the drug investors are taking to make them believe that the economy is just going to snap back, and there's going to be no vaccine, and everything will be back to normal, and it'll be just wonderful. In fact, maybe even better than it was before. You can read the quote here: "If something is true, no amount of wishful thinking will change it." That's my belief. I think the economy is in serious trouble, and it's not going to be a snapback. We're going to feel the effects of the pandemic for a long time. Hopefully, we'll find a vaccine, which will work with the health effects. And then the other thing that I'm reading every day now is don't fight the Fed. So the Federal Reserve is trying to buoy up the stock market, and certainly the bond market. It's been manipulating the bond market for a long time. I'm going to talk today. I think that's working, by the way. So I think it has succeeded in causing prices of bonds and stocks to be higher than they should be. And that in the economic terms is called money illusion. And I'm going to talk about that too. So I think these are two reasonable explanations.
Yeah.
But in terms of what's going to reconnect the market with the economy, the economy is going to come back, which, yes, it eventually will, but it could take, I'm going to throw this out too, I'm going to talk some more about this. The Great Depression lasted a decade.
Oh, gosh. Is that what we're looking at?
I don't know. People are pointing out similarities, and I'll even say the similarity right now. So the Roaring 20s is what set the stage for the Great Depression. And I'm going to show you how the markets got inflated and things got really expensive, and then everything crashed.
Well, Ron, let me ask you a question right now. The mindset that you think that the baby boomers have right now, do you think it might be, well, I'm at the end of my life and none of this is going to happen in my lifetime and I can just really sit back? It's like looking at somebody having a hurricane in their area, but it's never going to happen here. What do you think the mindset is?
I think there's some of that, but I think mostly, at least the people I'm talking to, are relying on somebody else, somebody smarter than them. And one of our shows was on the 70-year history of investment consulting. And there's this thing just entrenched in investment consulting called the 60-40 rule. 60% equities, 40% bonds. And I don't think it's accidental that the average individual retirement account, IRA, for people in their 60s is 60% in equities and 40% in bonds. It's also 60% equities and 40% in bonds for 20-year-olds. So that sort of rule, I think, is just totally gotten entrenched, and it's wrong, and certainly wrong for baby boomers. The other thing I'll say there too is target date funds are the biggest deal in 401k plans. And that's for people who can't make a decision. They don't know what to do. And those two, for people in their 60s, are they're not quite 60% equities. They're 55% in equities. But most of the balance, at least 30% of what's left, is in risky bonds, long-term bonds that are paying nothing. So 55 plus 30 is 85% risky assets. So I think boomers want to believe they're okay because someone smarter than them has told them that they are. And what we've been saying for the last 7 months is get in touch because
they're not as smart as you think they are.
You're not safe.
Yeah.
And I don't want it. I told you so. I really don't. I really would love to see people heed our warnings.
Yeah, really, what we're all about is just to give you give them information so that they're informed and they can make intelligent decisions.
Exactly.
And have options and resources. People don't know what's available.
So, I think most of them aren't looking, and that's to answer your question, Kat. So, you watch the news every night. It's all about COVID and people killing each other, and very little about you're warning anybody that they're maybe taking a lot of risk in this current market conditions.
Yeah, so see, that's why I was saying that. Excuse me a second. That's why I was saying. I was thinking that you see everything on the news and people losing their businesses and they're closing down. They're having to go bankrupt. They can't pay their employees. But boomers don't have that to look at, so that's not an issue. So their impact in terms of the virus, I think they might feel that they're removed from it. But what you're saying is that from an investment standpoint, they're not aware of it, and now they need to be. Yeah,
that's exactly what we're saying. So okay. we're trying to scream from the hills, watch out.
Yeah.
Please. So let's talk a little bit about the recession first, Kath. And then, so the economy is in a recession. And the two things signal the recession. One is the next slide, which is gross domestic product, GDP. And the economists define a recession as a decline of 10% or more in gross domestic product. And we've just had that. So through August of this year, the U.S. is down 10%. Now, these bars are sort of interesting because they're annualized, which sort of is deceiving. What they're really saying is take what happens each quarter and multiply it by 4 roughly, and you get that number. But what you can see is the U.S. economy has just been growing a little bit. And that's one of the things that people were concerned about over this. So the decade of 2010 was one of the longest stock market recoveries in history. And it was also one of the least substantial in terms of growth of domestic product. It's flat. So when we came into the coronavirus, you can see in the first quarter, annualized, it was down about 5. In the second quarter, people are reporting on a 32% decrease in GDP, but that's annualizing a 7% decrease. So I'm just sort of saying, when you hear that sensational number, it's really magnifying what is already a pretty bad problem. But just for the record, we are officially in a recession. We've had a 10% decline in GDP. We may see recovery in the fourth quarter, but right now we are officially in a recession. I personally think there are reasons to believe we're going to stay in a recession for some time, but time will tell. We'll see how things go. The other thing that signals a recession is unemployment. So what we saw in the next slide, Kath, is when we had the Great Recession of 2008, as it was called, unemployment got up to 10%, and then over the last decade, recovering, and we've had great employment numbers. And then the pandemic just shocked the economy and brought unemployment up to 15%. The highest unemployment we've ever had was 25% in the Great Depression. So far, it looks like we're going to be okay because that unemployment number has now come down to a little above 10%. So this recovered
I see
some.
that here. Yeah. Okay.
Yeah,
So it's over here. Yeah.
exactly. It's over on the right. The other thing that's happening is unemployment claims, which is on the next slide. They skyrocketed right away in terms of the recognition that there was a pandemic, and then they've been coming down. So the market and the people are looking for any good news, and the good news in this thing is that the unemployment claims have now stabilized at about 1 million per month. Now, I don't think that's good news.
Yeah. Yeah. It doesn't sound like it.
But relative to where it started, it certainly is good. So it's sort of like the quote about the optimist falling from the skyscraper, and he was heard all the way down. You could hear him say, "So far, so good. So far, so good."
That's a good one. Yeah.
Yeah.
Boom.
Yeah.
Splat.
I'm afraid that's what's happening here, and
Yeah.
so we're in a really crappy economy. Some think it's going to be as bad as the Great Depression. But right now things seem to be stabilizing. But we could have flare-ups. We could have a reversal of the virus. But also we're going to talk about, and we did this in our second show in February. We talked about the threats to the economy and to the stock market, and there are a ton of them. The coronavirus is just one. So I think part of what investors are doing is they're closing their eyes to all the other bad news that's this threatening out there, and focusing on any good news that might happen about the virus. But there's more stuff out there. So let's talk about the stock market now, Kath. So it's reaching new highs, and maybe we can go to the next slide. So on the left-hand side here, here's where the S&P has been so far this year. And looking way to the far left, as we came into 2020, market commentators were saying this decade we're not going to get another decade like the 2010s. It was phenomenally good. And watch out, because right now the stock market is not fairly valued, it's overvalued, it's very expensive. And part of that has been quantitative easing. The Federal Reserve had put $5 trillion into the economy. It had totally suppressed interest rates, getting them down to zero. So things are being manipulated and just not right. And then you can see as we get basically into February of this year, there was an official declaration that we have a pandemic. So the word COVID-19, by the way, is coronavirus December of 19. So the first sort of recognition that we had a new virus, a novel virus, was in December. But it took a couple of months for the world and the U.S. economy to sort of recognize that what we really had was a pandemic. And then once that reality settled in, we had this 32% decrease. So from middle of February to middle of March, the stock market went down over 30%. And many people, including myself, said that's a good thing. And the analogy that was used, and one that I really liked, was that the virus is the match that lit the overvaluation tinder. The market needed to correct. It was way, way too expensive. But you can see what happened since. The market has recovered. People are already clapping for this. Is not quite a V shape, but they're calling it a V, and they're saying it's over. We got past that one. It's all good.
And it's not.
I don't think so.
Okay.
All it's really done is recovered to almost where it was before. But if you look on the graph on the right, profits have totally tanked.
Yeah, look at here.
And they're not back. So we're saying the same price that we did at the beginning of this year when markets were way overvalued for fewer earnings. And what investors are buying when they buy a company, they're buying the earnings of that company. And earnings are way, way down. So things have become even more expensive. And the next slide, really, I'm going to spend some time on because it's got a lot of important information on it. So investors really now are ignoring these measures that we've had in place forever about when does the stock market become expensive. And the price earnings ratio is one of those, and that's what we're showing here. And you can just look at this when you see where price earnings ratios, by the way, the red line is the average price earnings ratio. It's about 16. But the measure I'm using here is called the Shiller price earnings ratios. There are others, but this one seems to work pretty well for signaling really expensive stock markets. So the first spike over on the left there is the Great Depression. And what happened was during the 20s, we had the roaring 20s, and the stock market just roared right up and then crashed. And you can watch the lines go back and forth for the next 10 years. The Great Depression lasted a decade. And then the next sort of run-up we had was in the 1960s, when we had a phenomenon called the Nifty 50. So these bubbles happen. And I went to the University of Chicago, which is, some people say it's a school where nothing matters because because markets are supposed to be efficient. So whatever the price is, that's the right price because investors are smart and they read and they figure out what the right price is. But yet, there's no denying that there have been bubbles. And what a bubble means is at some point things get really, really expensive, and that stops. Things get repriced. So we had in the 60s. Then the most recent one was the growth stock bubble in the 1990s. And that one, you can see, it was the highest level of P ratios ever. It reached 43, which is more than twice the average of 16. And we know what happened then, that the market totally tanked. Mm-hmm. And then what you're really seeing in the next blip after that, so it recovered until we had a housing crisis. And what caused the next market crash wasn't the stock market, it was the housing market. And that caused the Great Recession of 2008, 2009. And that brought price earnings ratios back down to 16. So we were back down to sort of average. The next decade then brought us back up to the second highest price earnings level ever at 35, more than twice the average. Now, the other thing I'll say here is that there's another really good measure, and I should have thought to include it in the deck, but it was too late. So I'm just going to tell you on this graph. Warren Buffett has a measure that he uses to sort of figure out if the market's priced too highly. And his measure is the ratio of the value of the stock market to gross domestic product. That ratio normally runs at around 80%. So put it another way, the stock market is normally about 80% of GDP. When the growth bubble inflated, that ratio was 130%.
Whoa.
So the stock market was 130% of GDP. Today, the stock market is U.S. stock market is $37 trillion. Gross domestic product is $20 trillion, $21 trillion. That ratio, if you could do it in your head, is 180%. 180. Just astronomically high. And part of what's going on there, and it's the rationalization that people use, is over in the left-hand corner here. So people are saying, no, not all the stocks are up. And in fact, if you look, it's what's called the FANG stocks. Facebook, Apple, Amazon, Netflix, and Google. Those 5 stocks are just skyrocketing. And they were very expensive coming into 2020. And now the epidemic, the pandemic, has really made these stocks even more popular because people are staying at home. They're getting on Facebook and talking to their friends. They're using their computers, their Apple, they're on Amazon all day long.
Yeah, yeah.
Netflix, we watch Netflix movies.
They're using telecommunications for communicating. Yeah.
Exactly. So these stocks are just skyrocketing. Google too. So they now just these 5 stocks represent about 23% of the S&P 500. So
Whoa.
yeah, so they are driving performance of the S&P 500, and people are using this as explanation that that's all good. Those stocks deserve to be that because they're really good stocks, and everybody is using them. But let me just hone in on one. Apple is almost worth, you ready for this? $2 trillion.
Whoa, really?
Now, let me put that in perspective. If Apple were a stock market, total stock market, hundreds of stocks, thousands of stocks, it would be the sixth largest market in the world. And it would be tied with Canada. It'd be about the size of the Canadian stock market. And it would be tied with
What?
India. Yeah. This one stock.
I wonder, is that why they were in front of were they in front of the Judiciary Committee? I think it was.
Yeah, I mean, when you get to be that big, there's certainly monopoly kinds of things concerned, and all the power that you've got. $2 trillion is a lot of money and a lot of power.
You're talking Amazon or no, Apple. Did you know that I knew Jeff Bezos when he was working out of his garage? Lou and I met him.
Yeah, he speaks highly of you.
Does he? Yeah. Oh, thank God he remembers me.
Yeah, he does. Yeah. I did not know that, but you've got that going for you.
Yeah.
It's like like in Caddyshack when the guy keeps saying, "I met the Dalai Lama." I got that going for me.
Yeah, right. Yeah, right. Well, I did meet Mother Teresa, so I do have that going for me.
Yeah, you've met a lot of influential people. That's great.
Okay.
So I don't see how investors can not get in touch with how expensive the market is, and in particular these FANG stocks. And when people explain the FANG stocks, they go get on board because they're only going up. And no, again, I think that's wishful thinking.
Yeah.
So the next slide, I just want to talk about the V-shaped recovery. Again, I mentioned the decade that it took to recover from the Great Depression. During that time period, there were 12 V's, if you will. Market went up, went back down, back up, back down. The very first rise was called the Fool's Rally. So early on in the Great Depression, the market zoomed up, but it didn't take long for it to tank again, and it repeated that process 11 times. So, by the way, the circle over on the right here is where we've been so far in this recession. I am in the camp, and the debate is about, do we have a V, or is that the first leg of the W? It wouldn't surprise me even a little bit if we get a whole bunch of W's. And we're going to see fear and greed are big motivators. And I think right now we're sort of in the greed mode. But if we look at the next slide, which is really interesting, gold, which is a fear trade, has reached its highest level ever, $2,000 an ounce.
Wow.
And people say to that, well, one of the explanations is the rich people are hedging their bets. They want to be in the market. They don't want to miss it. But they also want some insurance, so they're buying gold. The other justification is all this money that the Fed is pouring into the economy. We're going to talk a lot about that in just a little while. Is going to undermine the value of the dollar. So when you price a commodity that has value in dollars, and the dollars are worth less, the price has to go up. So that's what's going on with gold. So let's talk about the Fed. The next slide. This is an election year, and I think even though the Federal Reserve is supposed to be apolitical, when Congress agrees to put money into the economy, the official source is that the Treasury puts that money in, but we're going to see that it's really the Federal Reserve who is the mechanic behind the scenes. So I think part of why we may be seeing the stock market holding up is it's an election year. And you can already see the Democrats pushing on Trump. Botched it on handling the pandemic, and he did this and that, and Trump is coming back and saying, but the stock market's okay. So investors get it. They see that what I'm doing is okay. And that's just the reality of what's going on. But let's look at what the Fed has done so far on the next slide. So before the housing crisis of 2008, the Federal Reserve held about $700 billion in reserve. And the normal function of the Federal Reserve back then was to operate on the fringes, to fine-tune the economy. If inflation heated up, we'd raise taxes. If there was the economy wasn't heated up, you put a little more into it. But $700 billion was a relatively flat amount of money to be held in the reserves for many, many years. Then, in 2008, the Fed put, first of all, $1.5 trillion into the economy. Then they raised it to 2.3. Then finally to $4.5 trillion. And that's when they started to taper off. And in the fourth quarter of 2018, the stock market reacted to the taper, and the fourth quarter saw a significant loss. So the stock market didn't like the Fed taking the punch bowl away. But that be it as it may, when we came into 2020, the Federal Reserve balance was close to $4 trillion. Now, what happened there that promoted this reaction was in 2008, the gears of the economy were going to just lock. And it would have been as ugly as could be. So the Fed really did come to the rescue. And it brought to the forefront a theory that's now come to be known as modern monetary theory. And I'm not sure it's really a theory as much as a justification and rationalization. We're going to talk about modern monetary theory, but it appears to have worked. I'm going to share with our listeners and viewers why there's going to be a price to pay for it. But it did its job in terms of heading off what would have been a terrible, terrible recession. But I think in many ways it just deferred the pain. Then what we're seeing here in terms of what just happened, the Fed put $3 trillion into the economy in COVID relief. And I'm just reading now that Congress is starting to agree with the next round, but it's likely to be on another 1 to 3 trillion. So we're maybe looking at $10 trillion in the Federal Reserve. And that's money that could cause inflation. It doesn't have to. I'm going to talk about how it could. But it's a heck of a lot of money.
Yeah.
$10 trillion is a lot of money.
Yeah.
And you can see there's no proof that the stock market went up during this time period because of the Fed. But putting $5 trillion in quantitative easing into the economy, and most of it found its way into the stock market. It's a $35 trillion stock market. It had to have some effect. So probably not all of that rise in the S&P 500 is Fed money, but a large part of it is. So that's what we saw. Then the next thing, I'm not sure why I put the slide in there, but now that it's in there, I just want to spend a second on it. So it struck me, this is weekly wages. And one of the funny things, the clear things to see is weekly wages are going up very nicely. And then when the pandemic struck, wages went up. And they went
well,
up
that was because unemployment, they paid $600 a week extra.
Well, I think that's it. And I also think that the people who stayed employed were the higher paid employees. So I'm pretty sure these numbers are about people who are employed.
Okay.
And it may include, the free money, the $1,200 that was sent to each person. So the funny thing to take note of is, if you want to increase wages, what you should do is have a pandemic. That's a
Yeah.
joke.
No, yeah.
It's a joke. So I want to talk a little bit about money illusion and the common comment that, so with quantitative easing, $5 trillion in the economy, we had no inflation. So it's all good. This is like a miracle. We have had inflation, but it hasn't been in the normal place that we look for inflation. It hasn't been in the price of groceries and in the transportation and things. It's been in the stock and bond markets. So the new money really did buoy up the stock market, and it did it in two ways. Rich people, most of that new money went to buy bonds, and rich people own bonds. They bought stocks, so it buoyed up the bond market and the stock market. But also a big part of it, corporations have been buying back their own stock big time. And I want to show you that on the next two pictures. And a lot has been written about that. But first of all, Trump has complained that any new money, no buybacks. I don't know how you stop that. But when you look at it from the management of a company, when you can borrow at 3%, and your company's making well north of 6%, you should do as much of that as you can. Just because, net, you're making 3% and it's virtually guaranteed. So it's no surprise that companies are borrowing as much of that. And the next slide basically shows that, in fact, the average company, this slide is a little hard to read, but the green line at the top is corporate profits. And the orange line underneath that is the amount of corporate profits that have gone to pay dividends and buy back stock. Virtually all of the profits have gone to pay the dividends, because corporations, once they declare a dividend, that becomes sacred. So reducing dividends is well known to reduce the stock price. So you can't stop paying the dividend you promise. But so you can see the steady dividends are the blue line. But then the rest of the profits have been used to buy back stock. And the bottom part of that graph confirms that. So buying back stocks has been a really big deal. Then in terms of the investors, on the next slide, I want to just reinforce that these bubbles and the explanation about, markets tend to be efficient, but there are times when investor psychology just causes things to go haywire. And the buzzword that's used is FOMO, fear of missing out. But the slide after that shows something really interesting that I stumbled across, but I think everybody will find it interesting. CNN Business put this research online, and what it's measuring is their measure of fear versus greed. And I'm pretty sure they use options to come up with this. So if people are buying more put options than they are call options, that means they're afraid. Put options are like insurance. If the reverse happens, they're buying more call options than put. That means that they think markets are going up, and that's a greed indicator. But what we see here is March of 2020, actually beginning in February through the middle of March of 2020, very high fear measure. But what they're reading now is that's come back, and now people are greedy. And I think that really explains what's going on. But what also you see here is greed doesn't last very long. and normally resorts back to fear. So I think that's what we're likely to see. Now let's turn to what I think is going to happen because of the Fed intervention. So regardless of how the stock market reconnects with the economy, there's $10 trillion in the economy. There's $7 trillion now with another 3 on its way. And that's not going to change. There's going to be $10 trillion in the economy. And I want to show you what almost everybody will agree is going to happen. So the next couple of slides get into the mechanics of how that money gets into the economy. So this particular one is about the $6 trillion being dumped by helicopter on the economy. And what's got to happen is the Treasury needs to release $6 trillion. And the normal buyers of Treasury bonds are the American people, Social Security and Medicare, foreign governments, Federal Reserve, and so on. The only entity on that list today that can buy that money is the Federal Reserve.
Really?
And that is exactly what's happening. The next slide is a report on just that fact. And what they're showing here is various time periods where the black bar on the top is what the Federal Reserve is buying, and then it breaks down into foreign governments and so on. But the bar on the far right is just showing you that right now, in terms of debt ownership, the Federal Reserve has absorbed all of the new, all of the difference from the, February of 2022 to today. Now, the next picture really shows the mechanics up front because it's really enlightening, I think. So what happens on the far left here is, and a lot of people say, well, they're really not printing money. That's true, they're not. So the Treasury basically issues bonds, Treasury bonds, and it spreads the money. And you got your check, I got my check. It says U.S. Treasury on it. That's their check. But then the only people who are buying the bonds now are the Federal Reserve. So the Federal Reserve has bought those bonds, and the bonds are backed by taxes. And I'm going to defer this conversation a little bit to modern monetary theory, but let me just say this. In theory, that $10 trillion is going to be paid back in taxes. Now,
From us, wow.
Well, in truth, we're not going to pay it. And so if you want to talk about the baby boomers sitting back and going, not in my lifetime, I think that's right.
Okay.
For this problem. But if they care about their kids and their grandkids and their great-grandkids and generations in the future, they're going to pay for it. This is the way it's going to be. So the next slide basically explains where inflation has been. So this big thing about, hey, $5 trillion, it solved our problem. It made the gears get back in shape. The economy's going again, stock market's thriving, and no inflation. This is so cool. There has been inflation, and it's been in the stock and bond markets. And economists call that money illusion. And it's hard, I can't get my head around it either, but it's basically like, if you got a $20 stock, you somehow mentally should say, if it weren't for this intervention, the fair value of that stock would be $15 instead of 20. So some part of what that current price is just isn't real. It's illusory. And what that should suggest to you is illusions are, well, just illusions. And someday they will probably go away. The new money that's going into COVID, much of it is going into the hands of the ordinary Joe. And he and she are going to use it to buy groceries. And we're already seeing it. My wife goes to the store and she goes, tuna is $5 a can. It used to be $3 a can. We got inflation. So I think we're just beginning to see it. But this new round is going to show its way in the traditional form, basically show up in the consumer price index, the CPI. And now let's talk about modern monetary theory.
Next slide.
Yes, please. So I used this analogy in one of my articles, and they told me I can't use it, but I can use it here. So in Gulliver's Tales, in one of the islands that Gulliver went to is called Lilliput. And by the way, Gulliver's Travels is a political satire. Even though it's called a kid's book, what Jonathan Swift was really doing was criticizing the government of the time. But the good news is he peed on the fire and put it out. And then somebody had to clean it up. And that's the whole thing with modern monetary theory. What it really says is if you can print money, you should use that to solve your problems. So use it to solve the financial crisis of 2007, 2008. Use it to solve the problem of the pandemic. And then I've said this, but I've gotten some flack, so let me try to say it more carefully. You need to worry about cleaning it up. And the mop that sops it up is taxes. And when I've said that, people have fed back and said, no, you may never have to clean it up. It may be that you never get inflation. I sort of understand that, but I don't. So what I don't understand is how you can pour trillions of dollars into the economy. The whole idea about what causes inflation is the supply of money exceeds the demand. And you're throwing $10 trillion into a $20 trillion economy. It's hard to imagine how the supply isn't going to exceed the demand. But if for some reason there's no inflation, there's no reason to tax. That's the theory, and I can see why that would be the case, but I can't see how it could be the case. So the last part of this is sort of fun. If the people on this call, I don't know if they'll remember Paul Harvey, but he had just a phenomenal voice. I mean, just the way I mean, you'd listen to him all day long. And his catchphrase was, "And now you know the rest of the story." And that's what you want to do in the next 2 minutes here. So this is basically a refresher. In episode 2, which was early February, we talked about the 10 threats. And 2 of those in particular are very important for baby boomers. So Kathy, you said at the beginning, maybe they shouldn't worry. I think these 2 threats could affect baby boomers in their lifetime. So gross domestic product is $21 trillion. That's the green bar. The debt is a little over that, 21 trillion. That's a bad thing. To owe more than the domestic product, more than you produce in 1 year, is a warning sign. But the real story is that Social Security, the value of the promise, and put it another way, the projected payments less the projected benefits of Social Security, the way things are now, will cost around $29 trillion.
Whoa.
That's bigger than the national debt.
Mm-hmm.
And people are right about this, call it the off-balance sheet debt, but it's a real debt. It's a promise. By the way, it's a promise we made to ourselves.
Yeah.
Because we are the government. Presumably the government works for us. 2018 was the first year where the tax receipts for Social Security were not sufficient to pay the benefits. So the first warning sign, 2018. The forecast is for Social Security to go run out of money in 2034. They're saying that the pandemic made that likely to happen sooner. But that's not the big problem. The real problem is Medicare. Its unfunded liability is $47 trillion. And it will go broke in 2026.
Wow.
Now
so
when I
there
say
goes the Medicare for all.
well, that's exactly right. So imagine what that 47 trillion would become if it was for everybody.
Yeah.
Now, the other thing, when I say go broke, people respond, well, there's print more money.
Yeah.
There's got to be a limit. I think we're testing the limit now. But I don't think these problems can be solved with more money printing. It's just not possible. So the other thing that's going on is on the next slide. We covered this also in our second show. It's on the next slide, Kath. there is a world debt crisis. So it's not just happening in the U.S. It's happening in China. Japan's had the problem for many years. Europe, it's all over. And the world debt crisis now, if you include all this off-balance sheet stuff, is 500% of gross domestic product. If you wanted to really bring it home, the per capita debt is $200,000. So if you wanted to send in yours now, that would probably be appreciated. Just get that done. So if everybody could send in $200,000, we'd have the world debt problem solved.
Yeah, there you go. Okay, count me in.
Yeah. We sent ours in.
Yeah, did you? Good.
Yeah.
Good.
So, the people who want to be socialistic and just say keep printing money and don't worry about the debt, look at the things that are surrounding the world debt. And the world debt is causing this problem. The trade wars, the gold prices, the bond defaults, inverted yield curve. I can't make out the bottom one. But anyway, there's all sorts of problems that are just flowing from this problem that just keeps getting worse. Then the last slide, and I think I will have scared our viewers enough. So on the first show, we talked about COVID-19 before it was declared a pandemic. We talked about the stock and bond market bubbles. And I guess it's always an opinion before the bubble bursts. So whenever we've had bubbles before, there's always been a rationale. So the FANG stocks, those big five stocks, we had those in the 1960s. They were called the Nifty 50. When we had the growth bubble, the explanation was trees can grow to the sky. It's different this time because we have such wonderful technology. So we got that going on. Per capita world debt's astronomical. But then we've had these other problems that haven't gone away. So we certainly have nuclear threats that I don't think have gotten better. North Korea and Iran. The trade wars with China, I think, are starting to escalate, and we're getting an attaboy because, hey, China caused that pandemic.
Right.
With Europe and so on. Hyperinflation is really tied to the debt, and we talked about Social Security and Medicare. But there are plenty of other threats. And then the next slide wasn't something we talked about in February, but it's here now. So we're seeing this is so funny. They're calling it protests. They're not protests. They're riots.
Riots. Yeah, they're right.
And they're happening. Now the excuse is that black guy got killed, and that's really sad. But they're using an excuse to rob and steal, and I think a big part of that is many of these people are suffering. They're poor, and they're getting struck by the pandemic. They're finding ways to get free stuff. So we're having social unrest, and that's one thing too. I'll say that the boomers who live in these places, they're feeling it.
Mm-hmm. And they're scared.
And they should be.
Yeah.
I mean, when the reaction to $10 trillion being poured into the economy starts to work out, there are going to be some really awful things happening. So on the next slide, just to say the same message we say in every baby boomer show. We're going to keep on saying it because we really can't tell if you guys are listening to us or not.
Yeah.
But our major message is you need to know how you're invested. And if you have an advisor, you need to ask him or her how you are invested and why, and understand exactly why. And if you're 60-40, which is a pretty good chance, stocks, bonds, you should not accept that. So if you're talking to your advisor and it turns out you're 60-40, you should argue with them at least, but maybe change advisors. If you're in a 401k plan and you're in your target date fund, there's only a handful of target date funds that are not high risk at the target date. In fact, 4 to be exact. So even though you're probably in your target date fund because you can't make a decision, I encourage you to make one decision now before it's too late. Get out of your target date fund So what happens on a 401k plan is you only get one choice of target date fund. And you should look and see what its allocation is. But I can tell you that the odds are very high that you're taking a lot of risk at the target date. So finally, the last slide, we ask you to support us. You can visit us on Patreon and get all the shows. If you want to support us with a donation, that's fine, but there's really no obligation. But we got some websites here that can help.
I put them in the and I didn't put Glide Path in there, but I do have the YouTube and our Facebook and the Patreon. It's in the description of this video.
Great. Well, that's on Facebook, Kath, right? Not on YouTube?
No, it's on YouTube too.
It's on both. Great. Okay.
Yeah.
All right. So H-Stage Robo is for do-it-yourselfers. And we got a lot of stuff written there, ebooks. You can get a sample for almost free, but if you're not doing it yourself, you can certainly use it to do a double check on your advisor. Glide Path Wealth Management is for those who want to use an advisor, and we give you some guidance there on how to choose one and so on. The Baby Boomer Investing Show, please look at our other shows. I think you'll enjoy them. And then for fiduciaries who might be on this call, there are target date funds that are safe at the target date. They're called smart funds, and it wouldn't hurt you to get to know that those exist and what they are. So thanks. This is our last episode of the first season.
Yeah.
And we're going to resume our second season now, middle of September, and hope you'll enjoy. And in the meantime, please watch our 15 previous shows. I hope you will.
Okay, great show.
Yeah. Thanks, Kath.
Okay. Thanks, Ron. See you in a couple of weeks.
Yeah, no, 4 weeks.
4 weeks, yeah.
4 weeks on this show. I'll see you before then. Kathy is my sister, by the way. So I'll see her before then.
Okay, bye-bye.